Five. All right, welcome all to this meeting on real estate investing with Eagle City Multifamily. And let me share my screen for just a moment, and then I'll introduce our amazing guest speaker today. And this meeting is not financial or legal advice. It is simply professionals sharing what we do and helping others get into the real estate asset as well. And so our host, the Eagle City multifamily team, is Nikki and Sanjeev Mall, and Asif Kumar and myself. And we're based out of the Dallas area. And a little bit of the agenda today is real estate markets and compared to other assets. And we'll be giving our attention to our amazing guest speaker here in just a moment. But before we do that, Eagle City Multifamily is a team of investors that look for properties, apartments, and we purchase and we raise capital to provide better than average returns. And we operate these apartments, and the investment is typically 3 to 5 years based on the market. And so let's jump into this call. I guarantee your time will be well worth the listen. Ripan Singh has been doing real estate for a decade in one of the nation's hottest markets, Dallas, Texas. He is a licensed realtor and investor. And Ripan, would you go ahead and share us a little more about your background and why you're in real estate?
Sure. Hey, Herb, thanks for the great intro. And hi, everybody. So my name is Ripan Singh. Everybody calls me Rip. Feel free to call me whatever you like. Rip the realtor, Ripan, it's all up to you. Anyhow, so just a quick brief background about myself, how I got into real estate. So I'm from a small town in upstate New York, and from a middle-class family, immigrant family, who worked hard, their whole life. And the mindset was always save, 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 and eventually invest. But I was always looking for, being young and with the power of the internet now, this is like mid 2000s. I'm always looking for different ways to make money and, get rich per se, right? Everybody's dream, make a lot of money, have financial freedom, whatever it might be. And what I kept coming across over and over again was they kept saying the most amount of millionaires are made in real estate. So that's what really intrigued me. And then, at a young age, I, started looking into real estate. I ordered a couple books. I started reading some books and basically how the market works. And then eventually I transitioned to get my license and started off as a realtor. And, I started that in New York. I eventually moved to Dallas, Texas. And, I've been practicing real estate in Dallas, Texas for the past 10 years now as well. And so if you add Dallas and New York, it's more than 10 years. But long story short, that's how I kind of got into real estate, and it's been great. I can't complain. And comparing to other asset classes, which we'll talk about here momentarily, you'll see why real estate really intrigued me and why I really got into it, and the leverage of real estate compared to like the stock market and the S&P, for example, right? And yeah, so that's a little bit of background on me, and I guess should we just hop right into the information?
Oh, yeah. Let's do this. You might even tell some of your hobbies, right?
Yeah, right. You never know. Um, so just to start off, I guess I'll share this real quick. We'll talk about the markets, right? So there's a lot of different ways we can invest our money and whatnot. And obviously markets is one way. A lot of investors they invest in the real estate market and they invest in a stock market and whatnot. But the difference between the two markets is really what you're getting in returns, right? At the end of the day, it's all about the numbers. So with that being said, I'm gonna share this with you real quick. Let's talk about Can you see this?
Yes.
Okay, so this right here is right from Google. Anybody can Google this information. It's all on internet. So the average S&P return over the past 50 years, right under about 11%, right? But if you look into it closely, over the past 50 years at the end of June 2023, so just a few months ago, a couple months ago, they're saying the average was about 10.8, right? We'll round it up. However, adjusted for inflation over the past 50 years, including dividends, it's roughly about right under 7, like 6.5% is what you typically will get returned in the S&P 500. So that basically means if you invest, say, 60,000, we'll just try to keep even numbers so it's easy to round up and all. So say you invested $60,000 into stock market today into the S&P 500. Basically, what they're saying is in about in a year, your 60,000 will typically grow to maybe about say 10%, right? Obviously, it's a little less, but once again, we'll round it up to keep numbers even. That means at the end of the year, your 60,000 is roughly right now about 66. Once again, it all depends on the market trends up and down. These are average numbers, right? So that's on the S&P. Let me show you another screen real quick. This is a NASDAQ. So, everybody's familiar with the S&P and the NASDAQ, right? So the NASDAQ, same numbers, 10.4, highlighted for you already, right? Overall. And at the bottom, it says more than doubling S&P 500. Remember from the previous example, roughly about 6.5%. So once again, you round it up, you're looking about doubling the NASDAQ. But still, long story short, annual return about average 10% in the stock market. So your 60,000 at the end of the year is about 66,000, right? Give or take. Now, this is why I like real estate. I love real estate. Let me rephrase that. I love real estate because there's a lot of benefits to real estate besides just growing your money. And in the traditional markets, you really just grow your money one way, unless you're getting dividends, which we won't get into. But that's still pennies on the dollars, is chump change, right? You can walk down the street and probably pick up more pennies than what you'll probably get in dividends. So let me share this with you real quick. I'm going to switch my screen again. So this is, I'm going to give a quick example of if you were to invest into a real estate property and the difference between the market and real estate. Now, this looks like a lot of information, but it's really not, and I'll break it down with you guys right here. So based on today's market trends, we'll say the average home value might be $300,000, right? We found a nice rental property for $300,000. We put down 20%, which is about $60,000. Remember, we're putting $60,000 into this property opposed to putting $60,000 into the stock market, okay? That gives you a loan amount about $240,000. High interest, remember, interest is a little high, so I'm doing this up a high interest rate. So average interest rate right now is around 7 to 8%, based on a couple other things which we won't get into. But we'll just say 7.2 for today's example is your interest rate over a 30-year period, okay? Your property taxes, we'll say average about $6,000 a year with homeowners insurance, or another about $1,800 a year, no HOA. And if you don't know what HOA is, it basically means homeowners association, right? So we have none of that. So give or take, our monthly payment comes out to about $22.79. We'll round it up, $22.80, okay? Let's even round up and more. We'll just say your monthly payment is $2,300 a month. So $2,300 is your monthly payment on this property that you just purchased. That's all expenses included, right? Let me actually go back one second. I want to backtrack if you don't mind. Let me go to another screen. Bear with me here. Sorry, I lost the screen.
No worries. A lot of great information there. That's
Thank you. Thank you. I wonder if I even downloaded it. Okay, we'll get back to that. I'll just tell you what it was, and obviously you guys can Google this information as well, right? So typically the return on investment right now in the real estate market is average about 6 or 7% increase on your property, right? Now it seems like a few points less than what the return on the stock market was, right? We said stock markets, let's say 10% annual return, and we'll say your real estate appreciates 7% annual return. So that means in a year, your $300,000 will be worth a little bit more, right? 7% more. And if you give me a second, I'll tell you exactly how much that will be. That will be $321,000 is what your property should appreciate in this crazy market we have right now. And that's at a high interest rate. Now remember, when the interest rate goes down, which it will 100% go down, it doesn't have to be today, it doesn't have to be tomorrow, it might be a year, it might be 2 years, it might even be 5 years, depending on how the Fed feels inflation's going and whatnot, right? All irrelevant information right now. But once the interest rates do start going down, that means your property value is going to start going up. Why? Because more people are attracted to purchasing because they can, everybody thinks they can afford more when interest rates are lower. But in reality, you're going to end up paying more for the price of your house. If this house was $300,000 today in this market, in a low interest rate market, say your interest rate is 5% or lower, you're probably going to pay $350 plus for the same exact property. Okay. So now going back to our example, say your monthly payments are $2,300, and I'm going to pull up another pad here, little whiteboard. So sorry, I'm using my mouse cursor, so my numbers look really ugly. Bear with me here. So we'll say your monthly payments are $2,300. You rent this property out for, we'll keep it round numbers, we'll say $2,800, right? So if you're renting out for $2,800 and your monthly expense is $2,300, that leaves you with a profit of $500 per month. Okay, we all get how we got that, right? You're renting out the property for $2,800 and your payment is $2,300. The difference is $500. So you are making $500 a month in passive income. Keyword, there's passive income. That means you invested your money one time, and now month after month, without you having to do anything, maybe you answer a couple of phone calls here and there, you're getting a return of $500 a month. Now, it may not seem like a lot, but I'm pretty sure everybody on this call wouldn't mind getting an extra $500 every month into their pocket. Yes or yes, right? Everybody loves extra money. $500 is $500. So at the end of the year, if you calculate the 500 times 12, you have a return of $6,000, right? So you made $6,000 in passive income over the course of 1 year, which you would get as well if you were to invest your 60,000 into the stock market, right? So right now your returns are the same. You're making 6 in the stock market, you're making 6 in the real estate. But here's the difference. In the stock market, your stocks aren't appreciating, right? To where they're appreciating, that's where you got the 6,000, but they're not paying you a monthly return on your money. And once again, if you are getting a dividend, you're probably getting a quarter, maybe a penny. You're not getting 500. You're not even getting $5 probably. Okay. So if you take your average return, so you got $6,000 and you invested $60,000 into the market, that gives you ROI of 10%, right? So to calculate that, you would take 500 times it by 12. Let me erase this real quick. Show you how I got that number. What happened here? We'll just do it like this. So 6,000 times 12 equals, I'm sorry, did that backwards. 500 times 12 equals 6,000, right? So now your return is 6,000 a year. So $6,000 is your average return per year, and your investment was 60,000. You would divide that by 60,000, which gives you your return of 10%. Okay, so now you're making 10% on your money that you invested. But here's where real estate really exceeds all other asset classes, because now your property that was worth $200,000 at the end of the year, if you go back to the first example, is also now worth $321,000 because of the property appreciation. So technically, not only did you make 6,000 cash flow, the asset you invested in also increased by 20,000. So really, at the end of the year, you made $26,000 opposed to $6,000. If you guys see the difference, so would you rather make an extra 20,000 at the end of the year, or would you rather just be happy with the 6,000? I think everybody would prefer to make an extra 20,000 at the end of the year. Yes or yes?
Absolutely.
So this is the one reason, the main reason why I really got into real estate is because you're making money multiple ways. So I mean, this is just two examples I've given you, but there's other ways to maximize your returns on a real estate investment, and that's such as depreciation. You know, every year you could once again you would talk to your accountant. It's not financial advice, and you know everything is based on situations are different, right? But you can get depreciation on your property. That depreciation is also a write-off. Anything that you do with your property related, whether you even have to go drive up to the property, that's a write-off, right? So now you're saving more money from these deductions and write-offs, along with the asset appreciation, along with your monthly cash flow. So as you can see, the difference between real estate and the market is, one is you just put the money there and you just collect one piece of the percentage, and the other you put the money there and you're collecting multiple pieces. And so that's really what got me into real estate. Just that little example right there to really how to make your money grow. You know, so when they say the rich are getting richer and real estate makes you millionaires, this is why real estate makes you millionaires. Not everybody's gonna, you know, get the Google stock when it was $100 and now it's $2,500, right? That it rarely happens. You might get lucky, but real estate you can come in at any time. In real estate, we say the best time to buy is today, and the other best time to buy was yesterday, right? So you can never
Right.
be wrong.
Right. Rippin, I was doing some numbers real quick, just in my head, right? For the example that you gave us.
Uh-huh.
So our initial investment in that example was $60,000, right?
Right.
We got 6,000 in passive income and 21,000 in the appreciation, right?
Right.
The asset appreciation. So that's about 27,000, right? And so
Absolutely.
that's close to half of our investment, right? So that's like 40 something percent
Exactly.
of return, right, over the life, right? So per year, actually, right?
Yep.
As so that's a lot
A
better.
lot. So that's 4x your money. You know, the same dollar investment, just depending on where you put that money, you can either, you know, get 10% or get 40%. You know, you can 4x it or you can just be happy with what you're at. But I'm pretty sure everybody that's on this call is trying to figure out how they can get passive and, you know, increase their net worth at the same time.
Right. And that is something that we'll talk later in this call in just a few minutes of how we do the syndications on the apartments. And so you can invest in with us or other operators, whoever you're comfortable with, of course, that you can invest passively and receive all of these returns that in this example in apartments,
Mm-hmm.
right?
Absolutely.
Passively.
Passive.
Yeah. But
And I was gonna say the thing is, so here's the thing though. So when we say numbers like 50,000, 60,000, people, you know, start getting like, oh my God, that's a lot of money. Where am I gonna get the money from? And you know, a lot of people get discouraged because they feel like, hey, that's a lot of money, and they think it's a risky investment or whatnot. But you gotta, the way I like to say it is like you gotta look at it like even life is like a game of Monopoly, right? We've all played Monopoly, so life is the same way. When we go around the board and you collect gold, that's basically you circling 1 year, right? That's 1 year, we'll say. And then when you collect gold, you get your 200. That's your, you know, you can be your tax returns. You're saving your money, uh, whatever other ways you've been collecting money in this time frame. The goal is eventually, as you're landing on these properties, you're picking up little green houses, and eventually, if you remember the game, I don't know when the last time you guys played the game, but But once you get the 4 greenhouses, you can upgrade to a hotel. In this situation, in this example, we'll substitute a hotel for an apartment complex, right? So you can start off small. Anybody can start wherever. You don't have to go buy $100,000 property or a $300,000 property. You can buy a smaller property, whatever fits your budget. But the thing is to get started today to start building that little snowball effect, because just like a snowball, the more you do it again and the more times you're crossing that goal, every time you pass goal, your numbers are getting bigger and bigger and bigger, and eventually it's going to come to a point you're like, all I'm buying are just red little apartment complexes and not even buying little greenhouses anymore, right? And so there's a lot of ways you can get into that. You can start small, or another way that I kind of skipped a couple of years, will say, I skipped go a few times, is because, and a personal example I'll give you is we looked at this investment property, commercial property, a few years back, 20 end of 2019, 2020. It was right around $1 million. So a 20% down payment is $200,000 on $1 million property. However, I didn't have $200,000 on my own, but I did have enough money to where I could have been a partner if I found a couple other people to funnel the money together, right? So you don't have to do this by yourself. This is the key. Nothing, you don't have, we have support all over the place. You just got to know who to talk to or how to do it. You just got to have the right knowledge, right? So me and 2 buddies, we got together. So it's 3 of us. We all put up, enough money to cover our down payment, closing costs, whatever. And we got into this $1 million property. So at that time, I didn't have 200,000, but I had 80,000. But with the help of my friends, and we got an LLC, we invest in this property. That same investment today, instead of an $80,000 where I invested 80, the same asset today is valued at 250 for me. So where I didn't have 200, I only had 80. That 80 turned to 250. Does that make sense? Did I or did I stick too fast? Right?
Oh, it does.
So for all of us now, because once again, the appreciation, not only did we collect a passive monthly income from this business, we also got the appreciation on the property. The appreciation of property is what took my initial $80,000 investment and increased it to $250,000 today in a span of 4 years, we'll say roughly. Along with, once again, the monthly income we've been generating every month over and over and over, year after year, right? So this is why, once again, I love real estate, and you don't have to do it by yourself. You can do it together. And I guess, Herb, you're right. You guys do the syndication, so you can definitely give more information on that and how that works. But remember, you got to know who you're talking to, right? And you guys are very credible. And so
Absolutely. There's a few things that are important. And one of those things is to know the team that you're investing with. And sometimes people talk to me and ask me about REIT. That's a real estate investment trust. That's the acronym for REIT. And a REIT is basically a mutual fund, except in real estate, right? And so you're investing in the fund, not necessarily the individual properties, right? And so you don't know what properties you're investing in or whatever. And so the only reason I'm saying that is the difference between a REIT and a syndication. What we do is our deals are done property by property. So one property, just say maybe it's 150 units for a 50 mil or 20 million, just say, and we all group together to make up that down payment, as Rip's example, right? That the down payment, it might be 4 or 5 million. And so we look and we bring friends and, people we know, like you and I, that might have 50 grand, 100 grand, 200 grand, 500,000 or whatever you have. And you can look at this deal, and if you're not comfortable with this deal, you can pass it up and look at the next deal that comes around, because of maybe the age of the property or the location, right? There's so many reasons, so many things that make it a great property, right? And so you can pass one up, you can wait for the next one, you can invest in the one you like, right? And then you can drive to the property, you can look at it. Every investor is a direct owner in the property. And so you get the cash flow as well as the capital gains. It also gets distributed out to all the investors. So that's a little about what we do.
That's awesome, and that's definitely way better than a REIT, because in a REIT, you're basically giving your money to somebody and you're trusting them to hopefully make the right investment for you, and you don't even know where that investment might be. That investment could be on the other side of the world in Africa, for all you know, right? But at least with what you guys do, you can actually go see the property, you can touch it, you can feel it, you can see it, and like you said, if you're comfortable with it, you can move forward. If not, you can on to the next one, right? You wait for the next deal.
That's right. Yeah. And so anyone that has questions, Chris, I'll see if anyone that has questions, please bring them up, raise your hand, or unmute yourself and ask it. Right?
Yeah, this is Asif Kumar. So how many doors you have right now?
Me personally, or are you talking to Herb?
You.
Yeah.
So
Herb is my partner.
So I have two rental properties. One I have is a long-term rental, is a house, and then I have a short-term rental property in New York, which is for Airbnb, and then my commercial property that I own is actually a gas station. So I'm kind of diverse in a few different areas of real estate at this moment, but I'm slowly, building my portfolio. So I started off as a realtor. I'm still a realtor, licensed realtor, but slowly I every time I cross goal, I'm trying to save up and just reinvest and reinvest and reinvest.
Yeah. So thank you, Ripan, for showing us how it's done, because you're doing it. You're right in the process of doing this. As so many people want to know how they can get started. And like examples like you that are doing it, right? And
Right,
that's
absolutely.
very valuable.
And anybody can do it, and that's why I kind of gave you that background. Is like, I came from a middle class family. It's not like my parents were able to kind of help me. They helped me with what they could, but it it wasn't a handoff, right? Anybody, you can be in any stage in your life, you can be any age in your life, you could be 18, you could be 50, it doesn't matter, right? But the thing is, you got to get started today. If you get started today, in 5 years and 10 years, you will see that growth. And what we do is not get rich overnight. We all know that, right? This is not a get rich scheme. We don't get rich overnight. It takes time, it takes patience. But the thing is, you have to do it and you have to be consistent. That's number one rule.
Yes, thank you. Anyone, any questions? Any other questions?
I got a question for you,
Sure.
Go ahead.
for Herb or for anybody on the call, really. So, is it possible? Because I was looking at the, what's my blank on the name, the Brookshire Squares today, apartment complex that's for sale. And so, and I think the minimum buy-in is 60,000. Is it possible for investors to pull the money together, like Rip was saying, for a multifamily deal? Is that possible?
Oh, absolutely it is. Yes, there's some of our investors. I've not done it myself, but and I'm trying to remember the name of this thing you can do. Basically, you form a LLC and several friends can put small amounts to make up the minimum investment, right? And then that entity does the investment in the property. Absolutely, you can do that. And I can get you the information for that if you like.
If you could, that'd be great.
And yes, I've seen the Berkshire Square. We've looked at that deal as well. But yeah, a different team has it under contract, right? So yeah. I think it's a great deal, right? So
I was just thinking about different ways, because listening to Rip just now, I just think that'd be a good idea for because I know some people that wanted to invest small amounts and they can't come into 60,000 right now. So I was wondering, again, the LLC and then having them pull together money. That's what I need to know.
absolutely you can. Yeah. And it's a pretty simple process that you do. There's a company that does it for you, basically, with
I did that. Herb. I did that. I invested. This is Asif Kumar. I invested one of the company in North Carolina with my friends, right? So they all put a small amount, about 25,000, I think, each. And they need my pitch over there. So I put it that one, 25,000. We all established the LLC. We were a shareholder for LLC. And then we invested through LLC in the company. So it's a very simple process. Because what happened is whatever is going to be investment going to be, whatever you're going to get the return of investment from your syndication company, they're going to send one check to your company. Your check, the main company is going to distribute K1 for all the partners.
Great.
Yeah.
So just by friendly recommendation,
Yeah,
before investing any property, make sure you will see the due diligence, and the due diligence should make a sense. Go back to Herb and a statement that make sure wherever you're investing, you need to know the operators and you need to know that due diligence.
yeah,
Yeah, and
That's
just
yeah.
very, very important for all of investors.
yeah, and just to touch on that, what Asa was saying is it could be different dollar amounts as well, right? So for example, if you have 10,000, your buddy has 20,000, and somebody has 5,000, it doesn't matter what the dollar amount is. Whoever wants to invest, they can pool in the money, and obviously what you invest is what your percentage in that deal will be, right? So if you invested 5% of the deal, you will get 5% return. If you invested 50% of the deal, you will get 50% of those returns, right? But the goal is to come up with that down payment amount together, and then you would split it up accordingly.
Correct. Right. You could put 1,000 or 5,000 if the group that you're investing with agrees to it, right? And I think the name of that is tribevest.com. There's a place that does it for you. Anyway, I can post it in the chat. Tribevest, I think. I'll check it out before I post it. So
I'm pretty sure everybody sees the ads that, you know, when you're scrolling through online that, hey, you can invest in this fund, or, you know, they need some other investors or whatnot. But all those are just, you know, advertisements that are going out. And those are all REITs, like Herb had mentioned earlier, right? Majority of those advertisements you see are all REITs. You really don't know where your money is going. But what you know, Eagle City is doing is a lot better than a REIT, in my personal opinion.
absolutely. Yeah, so all right. Any other questions? Rip, do you have any more for us?
I don't have any questions. I'm free to take some questions, and if anything comes to my mind with those questions, I'll gladly share.
All right. Well, that was some very valuable information you shared, the examples that you gave us. And so what we typically do on the show is give a $10 Starbucks gift card out to someone. And so this is Google Wheel of Names. And so Google decides who gets the $10 Starbucks gift card today. And it's stopping at Rip Sign. Okay.
Yeah, I never won anything, so I feel lucky.
There you go. This is your winning day.
I guess, yeah. I need to go play the lottery ticket now.
Yeah. So within the hour, you'll receive an email with the card, and you open it up, the email, and just scan it right there at a Starbucks and buy your drink. So
Get it. And like, I think you said this to me earlier, right? And it goes back to that picture you have in the back. A lot of great things happen over a cup of coffee, right?
right. Here
Yeah.
we go. Right. Good things.
Sir.
All righty. Well, we'll wrap it up if there's nothing else. Any other questions? So
Herb, should I just, I'll send you a text message or an email, would you prefer?
text is great. Yeah, you have my number, right?
Do. Rip, do you have contact information?
I do. I can share it over to on here. I can send you directly, whatever's comfortable. My email is my first name, Ripan,